Right. So accounting principle. Now in accounting, we have so many accounting principle. The first one is business entity concept or business entity principle. So in the business entity principle, the own and the business are considered as two separate parties. It means in front of the law, own and business are viewed as separate party. Everything should be recorded in a point of view of the business. Then if we move to the consistency principle. Consistency principle means the accounting principle or methods must be used consistently from one accounting period to the next. Right? Now you know accounting period means a period of 12 months. Right? Accounting period means a period of 12 months. Now let's say in 224 we used SLM method, straight line method of depreciation. So then in 2025 also we must use straight line method of depreciation. Consistency. So let's say here 5%, 5%, right? And another example, inventory valuation. If we are using 5 for this year, right? The next accounting period also, we must use FIFO method. So what is FIFO? First in, first out, inventory valuation method. Then duality principle. So duality principle means every transaction has a dual aspect, one debit aspect and a credit aspect. So debit aspect means receiving side. Credit aspect means paying side. So in other words, every transaction is recorded twice, one debit entry and one credit entry. Then move into going concern concept. Under going concern concept, we assume that business will continue for a foreseeable future. So what is this foreseeable future? Foreseeable future means long period of time, indefinite period. It will never end, right? And also under this concept, we assume that business is not going to shut down its operation within the next 12-month period. So why this concept is important? If we do not have going concern, we are unable to classify assets and liabilities as non-current and current in the statement of financial position. All assets and liabilities will be recognized as current asset if there is no going concern principle. So they move into the historic cost principle. In the historic cost principle, all the assets and liabilities are initially recorded at the price paid to acquire them. In other words, it means its cost. But there are some instances where this historic cost concept is violated. The first situation is when inventory is valued at lower of cost than NRV as per IAS 2. And also when property, plant and equipments are revalued. Move into matching concept. So on the matching concept, it is stated that during an accounting period, right, the expenses or the cost which is incurred to generate a revenue should be matched in that same period. For example, sales is matched with cost of sales, right? So can you generate a sale without having a cost of sale? No, right? In order to have a sale, we need to have a cost of sale. So that is why in the P&L, we match sales with cost of sale. Then move into materiality principle. In materiality principle, it is stated that items which do not have a significance to the decision making of the stakeholder do not need to be recorded separately. For example, if you let's say there is a stapler machine in a business and there is a puncher, right? So those are very insignificant value. We don't need to record them as asset. We can record those as administration expenses in the P&L. Another example. So let's say we have assets of 100 million in these assets of 100 million, we have forget to record $50 depreciation. Now this is insignificant, right? Immaterial. So this does not affect omission of $50 of depreciation, does not affect the decision making of stakeholders. Then move into money measurement concept. So in money measurement concept, it states that every transaction that has a monetary value should be recorded in the books of accounts. So for example, think like skill of the employees, right? Personality, talent, right? Goodwill, effectiveness of a good manager, right? Benefit of staff training course, right? Those are not recorded in the financial statements. And also the next concept, prudence concept. So this principle is called also as conservatism concept. In here, accountants should ensure that profits and assets are not overstated and liabilities are not understated. So in other words, if you have two accounting alternatives, you must select the alternative which has the lowest impact to the profit. So the best example is if you take inventory, let's say the cost is 200, NRV is 100. So as per IAS2, what we select? The lower of cost and NRV. So we select the NRV. It has the lowest impact to the profit. So an example for prudent concept is valuing inventory at lower of cost and NRV. Realization concept. So realization concept means revenue is only recorded when the legal title of the goods pass from the seller to the buyer. So this is also linked with IAS 15, revenue from contracts with customers. So here there is another concept which is not mentioned here, substance overflow. So on the substance overflow in accounting, what matter is not the legal title of the asset. So for example, in a lease, the legal title and the actual ownership are two different parties. So we have two parties, the lessee and the lessor. Right? So lessee means the one who buys that asset. Lessor means the insurance company. So substance overflow is mostly related with leases, right? And also this is matched with faithful representation. So that's the end for the accounting concepts.